In today's video, I am going to be breaking down ZWE and my thoughts on this ETF. It is a high dividend ETF. Currently, according to Yahoo, it's at 6.9%, but it's closer to 6.5% because they lowered their dividend, mainly because the options trading, of course, lower premiums right now. However, you'll see that across pretty much every covered call. But when we're talking about this ETF, it is the BMO European or Europe High Dividend Covered Call, and my thoughts are kind of interesting on this. So yes, it does have a high dividend. It's got really good volume right now. The MER is 0.71%. It's basically average when it comes to covered call ETFs. Basically, what a covered call ETF is they'll have, let's say as an example, 1,000 shares of whatever European company, and they will then maybe sell potentially a call option against 100 of them so that they can make that premium back while they're waiting for the stock price to go up. That is where you will get that higher dividend, or that higher yield, I should say, instead, because, of course, you're still getting the dividends from the underlying stock, but you're also getting the yield from those premiums. Now, recently they have, of course, gone down quite a bit. It was doing not bad before this March. However, of course, that whole thing in Europe is happening. So they were doing pretty well. They were actually trading within a trading range while they were recovering from this virus that hit right there. Just like Canada, Europe was not doing all that great when it came to the stock market, and neither was this ETF. It was starting to run just before the virus hit, and then of course everything went down, and of course they have had that somewhat of a recovery. But what's happening here? Well, the whole Russia thing is happening. And when it comes to Russia, we don't know what's going on. I don't even think the news or even the politicians over here in North America or Europe really know what's going on in Russia. Because it seems like the guy's gone crazy, but at the same time, he's always wanted Ukraine. So I don't know what's going on. It looks kind of interesting. It looks like this could be something that's bigger, and that's going to lead me into my next point about this ETF. However, really quickly, it pays every single month. Pretty much every covered call does, almost. And, of course, they did lower their dividend back in June of last year, mainly because of what I've been reading anyways. The premiums have gone down because there's less volatility in the options trading market. However, that usually picks back up when volatility returns to the market, in which case we're currently having a ridiculous amount of volatility, in my opinion, right now, because of what's again happening over in Ukraine and Russia. Its top holding is the BMO Europe High Dividend Covered Call ETF ZWP, which is the non-hedged version of this same ETF. Basically, what hedged versus non-hedged means is the hedged one will keep a little bit more cash to play the currency game so that, of course, we don't have to worry about the fluctuations in the currencies. We've seen the Canadian dollar go up and down against the American dollar, and that's actually a good example of this, where, as an example, let's say in the American dollar, even though this is a European ETF, this is just easier for us Canadians to try to wrap our head around it. Basically, if the US stock market went up 2%, but our currency went down 2%, then there would be no gain on the stock or the ETF. So keep that in mind. Same idea when we're talking about Europe, except it would be the European currency and not the American dollar. However, when it comes to ZWP, these are its top holdings, and we're going to see Roche, Nestle, and Novartis, and the one thing that makes me really confused is this. When you click on Roche, as an example, because they messed up with the links on Yahoo, it goes to Rogers. So make sure whenever you click on an ETF stock, you actually go to the right stock. And this is I am 120% sure is the right stock because I've done some research. And of course, this stock is actually a pretty solid stock. It's got a 2.7% dividend, and the average volume is 1.1 million shares. It's had a pretty good 5 years, and the virus didn't exactly affect it hardly at all, which is fantastic. And over the past many years, they seem to have upped their dividend. Now, this company does tend to pay every March, and not 4 times or 12 times a year. It pays once a year. However, the financials are pretty strong. They don't tend to have massive growth, but they are doing pretty well, and they've had in the past pretty high growth earnings, just not revenue. Nestle was the second company on that list, and it's got a 2.5% dividend, and the volume is pretty solid as well. And again, the virus didn't exactly really affect it all that much. It was basically down and returned very quickly within a couple of weeks or a month or so. However, it's had some pretty strong growth and is trading within a range, and it's at the bottom of that range right now. So as an individual holding, this could be pretty solid. They've also raised their dividend. Now, this is another company that does pay once a year, and generally speaking, a lot of European companies tend to do this. Again, financials are pretty solid. They have been growing their earnings, but their revenue has been decreasing. Novartis is the third company on this list, and it's got a 4% dividend. It's pretty solid. It's got some ridiculous volume as well. Now, of course, this one is listed on the New York Stock Exchange. However, Novartis, no matter where you buy it, it's the same idea as TD Bank. You could buy it on the American stock market and the Canadian one at the same time, and it's the same company. Over the past 5 years, it's been volatile like crazy, but it's pretty much traded within a distance. Yes, it is trading between $80 and $90, and oh my god, wouldn't this be an amazing stock to just absolutely day trade in a way? But either way, it looks like it's pretty solid on the stock market. And they do tend to raise dividends again once a year. They've had 2 beats, 1 meet, 1 miss, and they've been growing revenue, and oh wow, 2021 was a fantastic year for their earnings. Now, when it comes to Europe, right now, I would be staying away from any European holding with a 10-foot stick, mainly because we don't know what's going on. There are some analysts saying that this Russian government is not going to stop with Ukraine. We don't know. We just don't know what's happening over there. I personally am not going to be investing anywhere close to Europe. Now, always try to kind of see where you want to invest. Of course, you can invest in a lot of good companies in the American and Canadian stock market, but there's a few places I would never invest. One of which being Russia or China, because of course they're communist countries. I disagree with their government. However, that doesn't mean that it's a bad investment. That's just my own personal beliefs. Now, when it comes to Europe, it's usually a pretty solid place to keep your money and investments. However, right now, we just don't know, or at least I just don't know what's going on when it comes to how far Russia really wants to go. And if that's the case, and if Putin wants to basically destroy his country, then he's going to keep on trying to push. And we don't know what's going on in that guy's head. And because of that, I would personally stay away from any European investment. Even though I do invest in Bank of Nova Scotia, which does have a higher European presence, I would still stay away from any company that is based in Europe because we just don't know what's going on. I always stay on the edge of caution because, of course, I've worked hard. I worked my butt off for my money and I don't want to lose it. So it comes down to risk tolerance. I hope that you've enjoyed today's video. My thoughts are probably going to be different from yours or other people's, but it is still a good point to kind of think about. Anyways, I hope that you enjoyed. I'll see you guys again next time.